question is, do you belong in oil and gas? Do you as an investor really have what it takes to be an oil and gas participant? You know, I've been doing this since 1985, and what I have found is that there's really two qualifications for oil and gas investing. Financials, obviously, do you have the money? Can you afford to take the risk? Can you afford to take a loss? Can you participate so that way you can give yourself the opportunity to see the peaks and valleys of commodity prices, or the ups and downs of drilling a well and it's not quite the one you wanted. You got to move over and drill a second well, and you're basically trying to delineate a field. That's all money. That's financial. There's 9.5 millionaires in the United States. Those are the only 9.5 million people who qualify to make an investment in oil and gas, because you have to be accredited. You got to have $1 million net worth to participate according to the SEC rules. So out of 360 million Americans, whatever the number is these days, 9.5 million, that's it. So 3% actually qualify financially to participate in oil and gas. Here's probably a bigger question. Do you have the emotional qualifications to invest? Now, I can give you literally dozens of examples over my career, even with myself, who is a hardened, go get it, all's out, no qualms. I'm an entrepreneur at heart. I'm a risk taker at heart. I get over losses very quickly. I work my tail off. But I got to tell you, it's an emotional decision when you participate. Now, the way I've seen the investors in my career, we got a number of them. There to be 1 through 10 variations, but you have the analytical investor, the engineer, the manufacturer, the doctor. And what they want is they want facts and figures and data, and they want information, they want probability, and they will absolutely tear it apart from an analytical perspective. It doesn't help one bit when it comes to Mother Nature. It simply makes you have a warm fuzzy. So if I gave that person a ton of technical data, they'd probably write a check and participate. And the next prospect, it might not have as much technical data, and they probably wouldn't participate. And guess which well might hit? The second one with less technical data. Because the fact of the matter is, there is a subjectivity to exploration. The other type of investor is I make so much money, I don't really care. I don't want to learn. I don't need to know the well's name. I need to know you're not going to rip me off. I need to know you're going to put my money to work. Do I get my tax deduction? Even when you hit the well, in my income and my net worth, the little $10,000, $20,000 a month doesn't mean diddly squat. But at the same time, I like to win. So I'll drill with you for a couple of years, make some money, but I'm not really committed to this sector, and I'm not really somebody who's going to be a long-term investor. Another type of investor is going to be somebody who says, guess what? I'm not going to put it all in. I'm not going to jump here and there. I'm going to be your partner. I'm going to invest. I'm going to stay with you. And sometimes it's rough. I remember at one point we hit 19 dry holes in a row. We did. My company had 19 dry holes in a row. We were with majors and independents, and we were drilling 3D size and 2D size, and it was the worst string of luck I've ever seen. We followed that up with the next 5 wells, hitting some massive reserves in some Louisiana oil wells that, had you been an investor in all of them, you'd have made a profit, believe it or not. I'm in all those wells, so that's why I can tell you with candid face. So the way I view it is that a true oil and gas investor has to look at it from really 3 perspectives. 1, you need to invest to get tax write-offs. I don't care what your CPA says. I don't care about what anybody else tells you. If they took away the tax deductions, the intangible deductions, IDCs for oil and gas, 95% of all oil and gas private investors would not invest. It gives you a 30 to 40% cushion because you get to take a tax deduction, which means you're playing with the government's tax dollars to build your wealth. I write a check for $1 million, I get $400,000 worth of tax deductions. I like those kind of tax deductions. Now, in the last 25 years, I've tried to explain to everybody, as I invested my own money as a kid, it's not a deduction, it's a deferment. So first thing is, tax deductions are good, but if you're successful, it's just a deferment, because my revenue from those wells ultimately means I'm going to pay taxes at some point in time because I'm successfully drilling good oil and gas wells. Second thing about oil and gas, pick an investment increment that you're comfortable with. 100,000 a year, $500,000 a year, $1 million a year, 100,000 a year. Pick an increment. Don't try to pick wells based on the name, the location, your lucky sweater, your high school number, your combination of lotto tickets. That's all just guaranteed hit or miss, probability 0 of success. It's about saying, look, Troy, I've got $500,000 to spend this year. I'd like to put no more than 50,000 per well. I'll be in 10 wells. I need you to hit at least 60% or better, and I need the tax deduction, but I got to look at that at the end of the year and know that I've done a good job and that I've got a portfolio being built. And that goes back to choosing the right company that is going to help you make that selection. The third thing you need to know about oil and gas, it is not a 1-year investment. It's not a 3-year investment. It's not even a 6-year investment. We drilled a vertical well in 1992. The well came online, 300 barrels a day, 2.5 million a day in gas. For those of you who don't know, that's a really good well vertically back in 1992. We had reserve estimates. We put the well online. We produced the heck out of that well. We made our money back in, I think, 18 months. It was a great well. Just continued to crank. Had multiple formations in it, layers of reserves that we could go in and produce over time. Most of the partners, including the oil company that drilled the well, bailed out in like 1995, 1996, 3 to 4 years later. Everybody said, hey, we got a winner and let's cash out because it could go dry. I and about 20 of my partners stayed in that well. And here's what happened to us. When we drilled it in 1992, the price of oil was about $14 a barrel. Price of gas is about $1.65 per 1,000 cubic feet. Over the period of the next 20 years, that well lasted almost 18 years. 18 years. Price of gas went to size $15. That's a 10 to 1 increase in commodity prices, and oil prices ran to $145 a barrel in 2008. And what we did was we made more money in the 12th and 13th year after this well had already been producing in decline than we did in the first 2 years, because we stayed and we let commodity prices come to our favor. So in wrapping up what it takes to be an oil and gas investor, it takes you being honest with yourself that you're going to make a commitment to the sector. It means understanding that taxes are a tool that you use to use the government's tax deductions to help you create wealth, knowing you're just pushing off one day paying a lot of taxes on the income you make from all your oil and gas reserves, which I pay a ton. And the third thing is that you're going to have a portfolio, which means you're going to have to commit to a number of wells, and there's not a person on the phone that's going to tell you, or a person in face-to-face in a geological room that's going to tell you, hey, this is the right one, bet all the money on this one. What I'm going to tell you is I'm across every single well, and sometimes, in many cases, the well I don't expect to be the winner is the barn burner. And the one that you really expect to be a home run or the best well turns out to be the one that you go, ooh, we missed it. How'd you miss it? Don't know. Mother Nature is cruel. I'm Troy Eckard. Thanks for listening. I hope this has been helpful.